I'm sure you know the name Dave Ramsey. He's a personal finance personality, radio show host, author, and businessman with a net worth of over $200 million. Does the name Patrick Bet David ring a bell? He's an entrepreneur, author, financial advisor who's the founder of Valuetainment Investments Group and the PHP agency, who also has a net worth of over $200 million. Why do I mention these two names? Because these two very successful men in the financial world have two entirely different takes on the housing market. So we're going to talk about their differing views, building price reductions, layoffs in the real estate world, and what I'm seeing in the San Diego housing market. Hey, it's James Renfro. If you live in San Diego or you're thinking about moving here, I cover everything you need to know about America's finest city. And I have people reaching out all the time looking to buy or sell. So if you need help making a move, fill out my questionnaire below and I'll be in touch. Now, let's hop into the video. Dave Ramsey does not believe the housing market is going to crash simply due to supply and demand.
Supply is drastically short versus demand. Prices are not going down. There is not going to be a real estate crash.
There's simply not enough houses for the people who need them. Whereas Patrick Bet David believes that we are headed towards a crash due to the current recession, rising interest rates, builder price reductions, mortgage and real estate industry layoffs, and more. How are interest rates affecting the market? Let's say you bought a house and your loan amount was $500,000. At 3%, your payment would be roughly $2,108. Now, rates today are close to 6%. So your payment on that same $500,000 loan would be $2,997, almost $900 more. Now, if rates continue to rise to say 9% like Pat predicts, that same house you would have purchased in 2020 at a 3% rate, now you're looking at $4,023 a month. Nothing has changed except for the rate. Your payment has almost doubled, and that's why we're seeing houses sit on the market longer, because sellers haven't reconciled with the fact that the hot market is over because interest rates are rising and they're still listing their homes like rates are in the 3%. Prices will have to go down and potentially 30, 40, even 50% in some areas, according to Patrick Bet David. Now, when it comes to builders, a recent Bloomberg article said, builders are stuck with too many houses as U.S. buyers pull back. One developer says they're cold calling agents daily and have a menu of incentives from $12,000 towards closing costs, and that buying down rates will be an ongoing incentive from here on out. This is a really different tone than from a few months ago when builders could name their price and buyers would wait in line to do so. Now let's look at layoffs happening in the real estate world. Mortgage layoffs surge as rising rates crush lending activity. Major brokerages, mortgage lenders, and property tech companies have all announced varying degrees of layoffs over the last few months, and experts expect the trend to continue. The layoffs are a response to the cooling housing market. Redfin and Compass both announced more than 900 job cuts on June 14th. We've already talked about Zillow layoffs of 2,000 employees, but interestingly enough, home builders are adding jobs in 2022 despite a drop in new residential construction projects. The home building industry has just been desperate for skilled workers, says Robert Dietz, chief economist for the National Association of Home Builders. There is some crazy stuff happening in the world, our economy, and the real estate market. So let's zone into the San Diego housing market. So we haven't seen a huge jump in inventory with just 4,254 units for sale at the end of August. Now, that does represent a 27.9% increase over the same time last year, but we actually had a decrease of 13.7% from last month's numbers. But on the other hand, we've seen a dramatic drop to 2,129 sold units, which is a decrease of 42.2% from August of last year. So what does all this mean? So it's hard to say what the future holds. I think there is some truth in what both Pat and Dave have to say. I don't think that the rosy picture painted by Dave Ramsey is going to be quite as rosy as we all hope it would be. But I don't think that the doom and gloom painted by Patrick Bet-David will be quite as dim and cloudy either. I grew up in a real estate family and started my career back in 1989, so I've seen my shares of ups and downs in the market. I was there in 2008 when the housing market turned upside down, and I believe the market is in a much different and better place than it was then. But at the same time, the government continues to print money, spend it all, and then print some more. This is not a recipe for success, and the American people are paying the price. Thanks for sticking around. I hope this video was helpful. If you have any questions about your specific situation, fill out the questionnaire link below and I'll reach out. I hope you have a great rest of your day, and I'll see you next time.